I don't know if you were listening to us at the top of the program. Joe said, do you think we could get to $7 a gallon, sort of Europe style? And so I think that's actually a good question. Let's start there. What do you think?
I think I would look for potential demand destruction if we get north of sort of $5. I mean, the price scenario to get to $7, I mean, that would, I think, involve a major escalation in this conflict in Ukraine, basically Russian oil becoming unavailable. But certainly, given the lack of refining capacity, given the alarmingly low levels of product inventories, I do think we can be talking about that sort of $5 a gallon scenario, which is not great at all for the White House.
In terms of getting to $5, what's it going to take? And more importantly, what's it going to take to reverse it?
I mean, the problem is if we start with the second question, what's it going to take to reverse it? We've already done the largest release from the Strategic Petroleum Reserve, 180 million barrels. You've had the Biden administration come up with, a number of other policy proposals. But the problem is we have no SPR for refining capacity. And you cannot build one of these quickly. And so we're basically dealing with two situations. We're dealing with, the commodity superstore facing possible sanctions in the coming weeks, and you have this lack of refinery capacity. So if you are the White House, there is no quick fix to this. Something to be worried about, though, is the situation in China, because China has really kept a lid on oil prices. I mean, the lockdowns there have been one of the bear factors in the market. Any indications that China is moving to lift those lockdown restrictions, that would push oil a leg higher.
So, but when you think about not what the administration can do or not, but just the cross currents, assuming the administration sits on its hands and the only tool out there is the Fed trying to effectively create demand destruction. I mean, that's what they actually have to do at this point. Come this summer, come this fall, where do you think prices, I don't want to say settle out, because I hope we're not settling out at these levels.
No, I mean, again, when we look at the point of where did we see demand destruction in 2008? We saw demand destruction around $4 a gallon. So if you adjust that for inflation, you're talking around sort of $5.20 a gallon. So if that's the point we start to think about sort of demand destruction balancing this market. But again, you have to pay attention to what is happening with potential sanctions on Russia, because there's no way to backfill Russian oil if we basically lose the vast majority of its exports. And there are other commodities as well. If you're thinking about the inflation story, the food inflation story is also incredibly alarming, given the fact that Russia has essentially shut in Ukraine's wheat. And so we have a situation over the summer where it's not just oil, it's natural gas, it's food inflation that are the big concerning inflation stories when you look at commodities.